The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending 17 May 2019. Well, I guess at my age, how the weeks go by, it's not halfway through the year, but middle of May. Having said that, I just returned from the Money Show in Las Vegas, Nevada. I'd say it was a very good show. I'd say the resource sector still is weak, as we all know. There were some good gold companies that were exhibiting there. Of course, I spoke on one of the biggest mistakes investors make in the resource sector. And then I had a second speech about money, past, present, and future. We dove into where we are going, probably with the cashless society and how the blockchain will play into that. Moving on, let's just review the stock market as I've had a habit of doing the last few weeks. And in the middle of the week, semiconductor shares were actually at support levels, and the Dow was trading back to its 200-day moving average. Amazon and Cisco were leading the tech sector higher, and the drug stocks were actually looking good for the healthcare sector. Merck and Pfizer were the ones that had the biggest gains this past week. But by the end of the week, the weekly sector rankings were showing a rather defensive market, and safe havens were actually the market leaders by the end of the week. Trade-sensitive groups fell the most, and of course this is with the ongoing quote-unquote trade wars that neither side seems to be backing down on, and this whole thing seems to be escalating. Falling bond yields, of course, hurt the banking sector and actually helped the home builders. And AT&T and Verizon actually had a strong week. The earlier in the week, stock bounce faded out on Friday. So interesting market. We'll see what happens. Personally, I just try to report. It's tough to call these markets precisely. I still think we're probably at a topping formation in the overall equity market. And as I said to my readership in the latest Morgan report that was published recently, I don't see much happening in the precious metals until we start seeing weakness in the equity market. I mean specifically the U.S. equity market. Well, first up, one of our favorite sites, Hedge. This is sort of a summation of what I've been saying for weeks, but the truth is the truth. It marches on, and you probably can't repeat it often enough. Global trade collapsing to depression levels. With the trade war between the U.S. and China re-escalating once more, investors are again casting frightened glances at a declining global trade volumes, which, as Bloomberg writes today, quote, threaten to upend the global economy's much anticipated rebound and could even throw its decade-long expansion into doubt if the conflict spirals out of control, end quote. Now let's put that into context. Basically what we had is the financial crisis of 2008, so over a decade ago. And what happened? Well, the banks did what really the only thing they can do, which is to print more money. Early on, the precious metals responded to that, especially the announcement of QE2, basically took silver from the $19 level all the way up to the $50 level. What happened is what wasn't anticipated by the silver market, which means most of the people that poured into the silver market were anticipating that inflation would hit Main Street. In other words, all that printing would hit the consumer. It would hit the average person. It would be higher prices for everything, soup, nuts, real estate, automobiles, you name it. And really it didn't. It really just was sterilized by going to the banking sector only, and it re-liquefied the banking sector. Once that was understood by the market, and there were 5 increases in the margin requirements in the silver market, we got this big fall off. Silver went from the $50 level and maintained a level around 30 for almost a year or so, and then started this ugly decline that we've seen for the last several years. Still convinced the bottom was in the end of 2015, and we are rebuilding a base. So, enough said about that. I won't read this whole article to you. It's good. There's some worthwhile charts in here. And what you can really see is that the exports to the world is the weakest since 2009. Big surprise. Exports to advanced economy, also lowest since 2009. And export to European Union is challenging the 2009 lows. So as I've said over and over, regardless of what the happy spin doctors put on the mainstream financial press and great economy and 3.2% and all this stuff that we hear, the truth of the matter is that we are contracting in the global economy. this is a good article that proves the point with data that you can actually capture, look, and study. So nothing to get all that concerned about. Just be prepared, live within your means. Keep your personal balance sheet strong, which means low debt, some good cash balance. I'm not a big proponent of holding dollars, but in this environment, you do want cash, and of course a precious metals position if you are so inclined and have the wherewithal to do it. People that listen to these weekly updates are probably of that caliber, but there's a lot of people out there that are just basically living paycheck to paycheck, and I fully understand that. And with that in mind, obviously all you can do is basically try to pay down your debt, live within your means, maybe cut back on things that maybe you want but don't need, and that type of thing. Resuming, and this is really a little bit more of the same. This is from CNBC. Latest data shows surprise slowing in U.S.-China economies as trade war escalates. The softer Chinese data casts doubt on what many had hoped were signs of recovery in the world's second biggest economy in March. This expansion, again, going back to what I was saying a minute ago, that took place from all the QEs, basically increased the money supply substantially, but did it really increase the physical economy? And the answer is not significantly. Enough to make the numbers look good, but if the economy is growing because you're printing money, that isn't true growth. And this is something that most people really aren't aware of. They just take it at face value. They hear what the proponents and the talking heads say on the main financial channels. They read what's in the mainstream financial press. And yes, there have been some innovative strides made through different sectors. I'm not trying to negate that. What I'm trying to explain is that the real robust, stronger economy where everyone's pretty happy, secure, jobs are good, on and on, that isn't happening. And it's obviously hurting both sides. And this trade war, of course, is not something I'm a proponent of. It exists, obviously, I have to report on it, but it is something that only weakens the global economy. It doesn't strengthen it in any way. And I can make an argument for why Trump's doing it, but I'm not going to go there because there's a lot out there in the economic system that's more important really than what's going on here, although this is the mainstream news and I'm going to report it. And as some of you know, the Morgan Report is about 40% Canadian subscribers. It is also printed in German. It's also printed in Spanish, and believe it or not, it's also published in Mandarin. But back on point, Canadian bankruptcies jump at fastest pace since financial crisis. Higher interest rates and a record large debt burden are taking their toll on Canadians, with the number of households filing for insolvency hitting an 8-year high in the first quarter of this year. So everything I've put up so far on this weekly perspective shows one thing and one thing only. The economy, one, is contracting, not only in the U.S., but globally. Secondly, that what you hear in the mainstream press primarily is more propaganda than truth. And lastly, that people are still overextended. And this is not a good setup for the next few years. I still believe that by the end of this year, 2019, not only will be in a recession, whether or not it's acknowledged by the mainstream financial press or not remains to be determined. However, we will be, and we will see further contraction and greater stress in the marketplace. Because of that, I expect to see the stock market in the U.S. start to sell off by year end, and gold catch a bid, and hopefully, and I would say hopefully, I'm pretty certain that we'll be above the 1350, 1360 area, which is critical technically for gold to start moving up into the next level. Time will tell. The last article up before I move into the metals. It's funny, but it's not. More than half the Greeks aged 25 to 34 live with parents. More than half the Greeks in their mid-20s to mid-30s live with their parents, a significantly larger proportion than the average of 28.5% in the 28-member European Union, according to the results of a survey by the bloc statistics service Eurostat, which made this data public on Tuesday. Specifically, 56.3% of Greeks aged 25 to 34 said they lived with their parents in 2018. The highest rate in the European Union after Croatia and Slovakia were rates that were 59.7% and 57% respectively. So if you go back to the Great Depression, a lot of families moved in together. In other words, as the Depression widened and went further on after the crash, mom and dad moved in with grandpa and grandpa and the kids and everybody else. So a lot of two households became one household. Very common. And if we had such a robust global economy, you wouldn't be seeing people, adults 25 to 35 living with their parents. So don't want to make too big a deal out of it. Just it's another data point that's absolutely out there. You can verify it, you can read it, you can see it, you can taste it, and it is reality. And we are in, again, my favorite expression, interesting times. So again, anyone listening to these podcasts, really get serious, because I think you're going to need to be serious by, again, the end of this year going forward. And the main thing you can do is, if you can live within your means and save, you are well ahead of everybody else. Even if that means maybe taking a notch down in your lifestyle, maybe taking that, as a quick example, if you are, let's say, in my age bracket, and the kids are gone, and you and the wife are in a big home, real estate prices are still pretty steady in a lot of areas, strong in some areas. You might be considering lightening up and moving to somewhere that's less expensive, where it's easier to live and maybe easier to maintain and that type of thing. I mean, that's just a quick example. I'm not trying to tell anyone how to live their lives. What I'm trying to point out is that it's good to be liquid, which means you have ready cash in whatever form, be it precious metals or cash in a money market account or whatever, especially as this reset, which really means repricing. A reset basically means that things that are really distorted, like what is the price of a bond, what's the price of a stock, what's the price of real estate, what's the price of a piece of gold, how much is wheat worth, that type of thing. All this stuff gets repriced. The market basically does a huge cleansing of stuff that you need, usually goes up in price, and stuff that you don't need usually goes down in price. Basically, anything that's bought on time or on credit decreases in price, and anything that's needed on a daily basis, such as food, water, maybe utilities, perhaps energy, cost more. Generally, I'm making a broad brush statement here, but I'm trying to give the correct idea. So I move on to the metals. I'm already 12 minutes into this, and I try to keep these at about 15 minutes. So I'll start with gold. I'm looking at Kitco chart. I'm not favorable to any particular deal. Well, I have dealers that I like, and those are some we have on our blog site, but regardless, and I like Kitco. I've certainly done business with them and sent them business. Regardless, the point being that over the last 30 days, gold has gone basically from $275, breached up, touched the $1,300 level, which is kind of the psychological level I want us to go through. I did change my opinion about that level, meaning that once we got through it significantly in January, I thought it would hold, and I was wrong. I admitted that. And then I restated that it'll probably take 2 or 3 more times to test that level before it goes through it and holds. So the point is, looking at the chart, we went from 1275, tested 1300, failed, and we're almost back down to 1275 again. So we've kind of done a round trip in the last 30 days. And gold has actually been holding up more than some of the other metals, which I'll show you here in a moment. And silver over the same period of 30 days, you can see, is basically not done a little move up and tested a resistance level. It basically went flat from 15, and it's down to 1440. Been some pretty bullish articles a few of my colleagues have written, and there are some very bullish fundamentals on silver. But as I've said in the past, and I want to reiterate, we're going to have to see gold pull silver up. As far as I'm concerned, could something come from left field surprise me? You bet. I've been in the silver market my whole life, and still it can surprise me from time to time. But the way it looks right now, I don't see it. Again, it could surprise me, but I'm looking for gold to lead the way, and silver is just really acting weak here. The gold-silver ratio is at 88 right now. If you're so inclined, it isn't a bad time to, if you can handle the risk, you might swap some gold into silver, but there's no reason at this point. We don't know what that top ratio is going to be. Is it 88? Is it 89? Is it 90? Is it going to go to 100, which it's seen only briefly a couple times? Could it get there? Yeah, it could. And taking a quick look at the other white metals, which very few do, and I do from time to time. 30 days of platinum basically looks similar to the silver chart. It was up to 900, and now it's down to 820. Basically, it was kind of leveling off for several trading days, and last month it was worth the trading, and then it just started to decline. The platinum gold spread is pretty big. Again, you might consider some possibility of platinum tightening up that spread and maybe taking gold and swapping for platinum. Full disclosure, I did that with part of my holdings recently, and it was working for a while. It's kind of even where I started about right now. I'm not that concerned with it. I think the spread will tighten, but I haven't seen it this big a spread for this long since I've been doing the metals, and you all know I've been doing it for decades. And the darling of the precious metals that very few people follow. We actually caught the palladium bull market. Unfortunately, I got out too early. Nonetheless, you never go broke taking a profit. Regardless, palladium over the last month regained itself all the way up to about its recent high, which is about 1450. It touched it briefly for a couple trading sessions, and now it's down to 1300. Similar actually to gold. I mean, gold, as you saw, kind of made that big push toward the 1300 level, touched it, that resistance level, backed off, and is back kind of where it started the month. Whereas here in palladium, it started around, I'll call it 1380 or so, and now it's at 1300. So similar to gold from the aspect is it tried to test the high, failed, and it's lower than it was a month ago. So all these metals, from a technical basis, are looking rather weak. Stock market, although it's near the highs, interior modalities with the sector rotation and what's happening with the defensive type of stocks and this trade war concern, etc., looks like it's weakening. So again, my basic theme for this week is we will see a shift by the end of the year. I don't think you're going to see a lot of strength in the metals during the summer, although they could surprise us. So keep appraised, keep tuning into the podcast for these weekly perspectives. I'll be back with you next week for more insights into the general economy and the precious metals. Hello, I'm David Morgan, publisher of the Morgan Report, and as some of you may already know, the Morgan Report is about money, metals, and mining. In fact, we cover all resources from rare earth elements to precious metals. I've been publishing on the internet for about 20 years. My primary passion is to help people build and preserve their wealth. I love to make people millionaires. I've helped thousands of people via our research in the Morgan Report, which has thousands of paid members and 10 times that amount on our free weekly updates. Here's what you'll receive from our free newsletter. To-the-point webinars, weekly analysis of the financial markets, interviews and our conference schedule, special reports such as riches and resources, and various metals price forecasts. Our paid service client base is primarily small to medium-sized business owners, professionals in the industry, or the seasoned investor who understands markets and the value of precious metals. My area of expertise includes equity analysis throughout the resource sector, energy metals, base metals. We cover startups to billion-dollar corporations. We focus on a special sector that makes money regardless of price oscillations, and the importance of precious metals due to the ongoing currency devaluations. Our team of 3 analysts and support staff can help you build and protect your wealth. It's important for you to know what other people have said. We're passionate about what we do. High integrity and trust. Tell the truth and own it. If we're wrong, we admit it. Take a long-term outlook with major assets and bet a little to win a lot with speculative situations. If you choose to become a client, you will gain financial insights very few, even professionals, recognize.
understand the importance of honesty in our financial system. You'll understand how the money system influences almost everything in your life. You'll be prepared for the ongoing currency crisis. And finally, I've chosen to make my life's mission greater than the individual, which means my mission statement is to teach and empower people to understand the benefits of an honest monetary and financial system. It's been a great journey so far, and the best gains in this sector lie ahead over the next 3 to 5 years. I'm fortunate to have earned the status of being a leading authority in my field in helping others protect their wealth. You can email me at support@themorganreport.com or call my office at 480-325-0230.